Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Stocks climbed Monday as investors eyed a looming U.S. government shutdown. At the end of the session, all the major indices did end the day higher. The gaming world may be playing at a new level after a record-breaking deal in the business. We're talking to an expert on what to expect next. And we're going behind the scenes of the Super Bowl of super luxury watches. Rollyfest is a growing event that timepiece lovers and collectors need to know about. We're giving you an insider's look. Well, EA Sports might be in the game, but EA shares are about to be out of the public market. Electronic Arts agreed to a $55 billion deal to go private, a move that could mark the largest leveraged buyout in history. For more, we're bringing in Jason Bazinet, the managing director over at Citi. Jason, always good to see you, my friends. All right, so EA going private, $55 billion deal. Saudi private investment fund, Silver Lake Affinity Partners. I guess my first question, Jason, I'm curious what you think they could do privately. What financial and strategic moves can they make, Jason, privately that maybe they would have had a tougher time doing publicly if they were still having to talk to you every quarter, Jason?
Well, I don't know. This transaction to me is a little bit of a head scratcher in that it wasn't like EA was unloved. It wasn't like EA was mismanaged. It wasn't like EA didn't have, sort of well understood catalysts. So it's a little bit of a head scratcher. I mean, it's a great asset, but if you ask me to tick off all the things that EA was constrained from doing as a public company that could now do, I don't think the list is very long. They had pretty wide berth.
How do you think about, Jason, Saudi Arabia's role here? I'm just trying to think through, you say it's a head scratcher. They've been making all kinds of moves, have they not, in the gaming industry?
Well, they have. I mean, Saudi, has wanted to get big in a lot of different areas in sports, with Live Golf. And so they want to definitely put the country on the map. They've been willing to spend money in other areas. I'm not saying that this is a bad area. It's just, when we ran the IRRs for the money that was deployed here, if you use the consensus numbers, which weren't crazy, it spit back something like a low to mid single digit IRR. This just doesn't strike me as the most compelling use of capital. If they would have went and, made an offer for EA earlier this year when they stubbed their toe on FC and the stock was $125 a share and the buy side was very angst-ridden about the future of EA and the durability of FC, that you could understand. But things were going quite well for EA. And so I just don't see a super compelling IRR. Maybe there's strategic reasons that the Saudis have for why they want to buy this asset, but on the financial merits, it's a head scratcher.
All right, so strategically a head scratcher. What are your thoughts on valuation for this deal, Jason? Was that a head scratcher? I did see some analysts saying it was roughly in line, they say, with the multiple paid by Microsoft for Activision Blizzard.
Yeah, that's true. If I went back over the last 7 years, this is about a 20% premium relative to what EA is traded at in the market. So it's not so much, it's just not like a deal. It's just it's sort of paying a premium off of a very fair public price is what I would say. And so what are they going to do that's different? I mean, look, if my IRR calculations are wrong, I don't think it's going to be the multiple that they come back out at if they come back in the public markets. Where I'm probably going to be wrong is if the consensus estimates are wrong. And why could the consensus estimates be wrong? EA has really been sort of a marquee video game company in the sports genre. They have never really cracked the code outside of sports. This Battlefield 6 reboot that they're doing October 10th, about 10 days from now, expectations aren't dour, they're not exorbitant, but the company I know is very focused on turning this into not just a video game that sells units, but sort of leaning into the live services and recurring spend inside the game, where really Call of Duty has been sort of the standout, and EA's done quite well with what they call live services spending inside its sports titles. So maybe we all just have mismodeled this, and this is going to be the next Call of Duty in the first-person shooter genre. That's entirely possible. But the irony of the timing of this bid is to put it in today, or yesterday, I guess it was today, the street's going to get a look at how many Battlefield 6 units come out. And if those orders fly off the shelf 10 days from now, the buy side's going to demand a higher premium. And so you sort of scratch your head and say, like, why did you put this offer in now? Could you have done it 6 months ago when we would have never known what Battlefield 6 was? Maybe that would have been smarter. It's just very strange timing.
What's the probability you would assign, Jason, to a competitive bid emerging?
I think it's pretty low. I mean, I would say when Microsoft went and bought Activision, there was a school of thought that maybe every cloud provider would go out and buy video games so they could offer consumers sort of a cloud subscription service, so people could junk their PlayStations and Xboxes and just buy a monthly recurring subscription to get their compute. And the thought is that you would be more apt to sell more of those if you could also give the consumer a library of video game titles to play along with their subscription for the compute power. But I think all of the big cloud providers now are so much more focused on AI, and even Microsoft hasn't really launched a cloud gaming service, that I think that's pretty unlikely. So I'm going to guess that there's not going to be a rival bid for this.
Jason, great to see you as always. Thank you, sir.
Yeah, absolutely. Thank you.
First Brands files for Chapter 11 bankruptcy protection. The move comes after weeks of turmoil and might be making Wall Street nervous. Yahoo Finance's David Hollerath joins us now. More. David, always great to see you on set. Start here, David. Big picture for the uninitiated, including myself. What is this company? What do they do? How did they get into this mess?
Yeah, so First Brands is a company that provides auto parts internationally, and their U.S. divisions filed for bankruptcy. So you can think of them as like a company that owns a group of brands of auto part items, like windshield wiper blades, brake pads, that sort of thing. And so this has been, so far in 2025, the largest bankruptcy. And it's very confusing. The company had a relationship of sort of multiple lenders who they borrowed from. And they had a particular kind of financing, supply chain financing deal that they were doing with all these lenders. So it's proved to be very confusing so far. They filed their petition this morning, so we're still learning more. Some of the names of some of them are lenders or just creditors in the bankruptcy now.
Yeah, who are the biggest creditors in the bankruptcy?
Yeah, so Raystone, which is a fintech company, is number one. They're providing a lot of this supply chain financing. And then also Nomura, Brookfield, a company, an investment manager called Facinera. You can think of a lot of these companies as like Wall Street money managers. And then there's Jefferies Financial Group. Their asset management arm also provided funding there. And they're actually going to be reporting after the bell. So we'll get some more information potentially there.
So this bankruptcy, do you think of it, David, and should we think of it as, okay, this is a one-off, kind of a unique situation, unusual, or no, if I'm an investor, I'm listening, I think, okay, this is some kind of canary in the coal mine?
Yeah, that's the question a lot of people are asking, because credit has been high, investment grade and also high yield credit spreads have been pretty tight. And that has been, a lot of people have been talking about that, not only in the auto parts industry, but also in like AI financing. And so that's what everyone's wondering. But right now, it looks like it's a very specific situation where this company was using a kind of factoring financing where they were borrowing short-term cash for their balance sheet. So that and sort of securing that with their inventory plus future customer payments, receivables. So you can understand how a situation like that can become kind of sketchy kind of quick, because if you have extra inventory that's not getting sold or customers not coming in, you potentially are having your margins cut and cut and cut. And all of this was off the balance sheet. So some of the company's lenders, First Brands lenders, didn't actually see what was going on. And that's sort of what sparked a lot of this. But if you go back to the last time this happened in a big way, it happens a lot of times in retail and industrials financing. But
why those sectors do we see that theme play out in?
It just has to do with supply, with the supply chain dynamics. But if you go back, there was a company called Greensill based in the UK, and their relationship with Credit Suisse ended in a pretty poor way when they were basically got to the short end in factoring financing, and there was some cases of fraud there. And so what you want to make sure of is that the lenders understood the risks going on here. Now, to the point of whether or not this is like a larger trend of like off-balance sheet financing that might be more widespread, this was actually caught pretty quickly. The company tried to refinance their debt in August, and the lenders asked for an independent balance sheet review. And within the next 2 weeks, their debt traded by about half the original price. So the market kind of figured this out pretty quickly. And then also another lender, Apollo, was actually shorting the company. We've now learned, Bloomberg reported about this out last week. So there's a lot going on here, and we're still kind of like waiting to figure out what exactly kind of the ricochet is, but we're not seeing any right now. Right now it looks pretty idiosyncratic, if that makes sense.
All right, David, thank you. Appreciate it, sir.
Thank you.
President Trump just wrapping up a meeting with congressional leaders as the clock ticks toward a shutdown. No deal was reached. The Senate's top Democrat, Chuck Schumer, saying moments ago that there are still large differences between the two sides. So what's at stake if the government shuts down on Wednesday? Julie Hyman has a closer look.
A partial government shutdown is just days away as lawmakers continue to debate a spending agreement. So we're taking a closer look at what a shutdown means for you and your money. Essential services will continue through a shutdown, including military, law enforcement, the Postal Service, the Federal Aviation Administration, and the Transportation Security Administration. But those workers will not be receiving paychecks. During past shutdowns, some TSA checkpoints were closed, and travelers faced longer lines when agents didn't show up for shifts. Non-essential services like national parks will close. In the past, some parks were kept open with state help, but with fewer visitor services, leading to reports of damages and trash pileups. The Smithsonian museums also typically close within a few days. As far as benefits, federal Medicare and Medicaid health insurance programs are considered mandatory spending. That means benefits will not be impacted. Social Security will also continue to be distributed, but staffing in some services could be affected and could cause slowdowns. As for SNAP benefits, they'll only be affected if the shutdown lasts for more than 30 days. That's because funding typically only allows the Agricultural Department to send out those benefits for 30 days after a shutdown begins. And when it comes to the market, stocks are typically pretty indifferent to shutdowns, with the S&P 500 rising more often than falling in the past. But it could have an impact on economic data, delaying key releases like the jobs report and CPI report.
Luxury watches are having a moment, even as tariff headwinds threaten to reshape the market. Collectors and industry insiders gathering at the exclusive Rolleifest event to showcase rare timepieces and gauge where demand is heading, including Yahoo Finance's Praz Subramanian, who joins me now. Praz.
That's right, Josh. What started as a 2019 meeting of watch geeks who met online has become a big in-person gathering, one of the most exclusive in the watch community. You know, Jeff Hess started it all. He's a huge watch guy. But also in his day job, he's the head of watches at Sotheby's, so he knows a thing or two about the industry and where currently Trump's tariffs are causing some disruptions in the new or primary market. So what does it mean for buyers? Here's what Jeff had to say about that to me at the actual conference.
We're still figuring this out. It's early. But what it does suggest is that in America, watches that are already here may very well escalate in prices. It's going to be slightly more difficult to get watches brought into the United States. So for a dealer, for example, he may have to charge a little bit more for his inventory, his existing inventory, because it's going to be harder to replace.
So while new watches will go up, many collectors are into the secondhand or vintage watches, and those values, of course, think about the used Rolex Daytonas, the AP Royal Oaks, the Patek Nautiluses. Those values soared as it was impossible to get new models. Now these watches have since fallen considerably in the secondary market, and while they're still higher than before the pandemic, I spoke to actor Fred Savage, a watch geek who has a new company called Timepiece Rating Specialist, about where he thinks the market is headed now and why he's still bullish.
The primary side of the market, yes, there's ups, there's downs, there's speculators, there's bubbles that burst. But I will say the overall market, as a whole, I think is incredibly strong. I think you have more and more younger collectors coming in. I think there are more and more brands that are available at a multitude of price points.
So Fred is kind of betting on these younger buyers who will buy both new and cheaper watches from independent watchmakers, but also use his company to evaluate older, rare watches when that time comes for them.
Can I ask you to do a full stop right there? How did Fred Savage get involved?
Apparently, he's been a big watch guy. I think his dad was involved in it, but he always loved like vintage and older watches. And the thing was, he had to kind of scratch his own itch, right? He's like, how do I evaluate a watch? I don't know what the authenticity of it is, what is the sort of provenance. And so he's like, why don't I do that for people? Why don't I make a company? So he has a company out in Ohio that has a bunch of specials. You send them a watch, they take it all apart, they look at it, and they say, this is a Rolex whatever, here's the reference number, here's the year, and this is our TGS sort of like a evaluation of this watch. So it has like a grade for whenever you sell it, wherever it goes from that point on.
We're gonna get Fred Savage in the studio.
I know, I've been trying to get him on. I know, I've been trying.
Finally, quick question. How much pricing flexibility, let me ask you, do these brands have if tariffs start to hit harder?
So they're kind of doing that right now, right? And I think the bigger brands like the Rolexes and the APs, like I mentioned, they can pass some of those costs on because their watches are very popular. They're basically sold out. So, hey, what's another $5,000 to some guy who wants a watch really badly? Now, no one wants to pay more money, but watches in demand, they can pass it on. I think smaller brands, I think more volume brands, I think like, let's say your Timexes of the world or maybe something a bit more like a Hamilton, a bit nicer watch. They can't pass on that much cost to people because it's a very price competitive market. There's so many watch brands out there. Well, if Hamilton's paying, I gotta pay more, I'll go to Omega, right? So that's sort of where we're at, where it's another a thing that companies have to think about in their pricing decisions, and I think they don't have much flexibility.
Any watches catch your eye in particular? Was on your radar?
I kind of like some of these flashier watches, to be honest with you. I saw a woman was wearing an AP Royal Oak, which is like one of these octagon-shaped watches. It was a skeleton watch, but it had a rainbow baguette jewel dial. I mean, it's for women, but I was like, this is a pretty cool watch, So she is very proud of that watch. But you see a lot of old Submariners, a lot of old Daytonas, so that's some cool stuff there.
Praz, thank you, buddy. Appreciate it. That is a wrap on Days Out for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.